Hello and welcome to MF Corner. I'm Sumaira Abdi. Today we answer the question that a lot of people have on their mind. Has the time returned to start investing in mid-cap funds? Well, did it ever go away? Shreyash Devalkar, Senior Equity Fund Manager at Axis Mutual Fund, who manages their very successful mid-cap fund, will tell us about the peculiarities of investing in this category. And later on the show, FISDM's Anand Dalmia will answer queries that you, our viewers, have been sending in to us. So first up, let me invite Shreyash Devalkar, Senior Equity Fund Manager at Axis Mutual Fund, who has an industry experience of 17 years, and he has managed the Axis Midcap Fund now for nearly 4 years. Hi, Shreyash. Good afternoon. Thanks very much. You know, mid-cap funds are peculiar, right? Because they're loved and they're hated in equal measure. Now we've seen for the last 2 months that money has continued to flow out of it. But a lot of people are saying that perhaps the time has come to start, buying small and mid-cap stocks. Again, is that the view of a mid-cap fund manager? Are the good times beginning for mid-cap fund investors? And are you at all concerned that, mid-cap companies may begin to default as this pandemic drags on? What are the benefits and the fears that you as a mid-cap fund manager have at the moment?
Hi, thanks. Good afternoon. So as far as mid-caps are concerned, there is first of all, the flows, outflows, what you are mentioning was seen in multiple categories. Was not only in mid-cap, but yes, mid-cap also saw some of them. Whether this is the right time to invest, it is always the right time to invest across any category. And why I say is in India, now we are a discovered market and we are a matured market. And this has been the case for last 2-3 years. So in that sense, it's not really wise to say that mid-cap are inferior companies. It's no more that is the case now. When it comes to the composition of mid-cap companies or small-cap companies, there, if you notice that during this pandemic and whether the cash flows will be strained, the market has always flocked to and valued more the companies whichever are deleveraged, which are having good free cash flow, and you will find many of them in mid-cap and small-cap space as well. So as long as you are investing in the right stocks, it doesn't matter whether we are investing in mid or small or large, you will take your right.
No, I entirely take your point about, the stock picking ability of a fund manager, right? I mean, that's what would stand the fund out, and, choosing the best of what the universe itself is just 150, right, for mid-cap stocks. But anyway, even if we look at the best and the worst performing mid-cap fund, over 1 year, the difference is 17%. Over a 3-year period, the difference between the best and the worst fund is 11%, and over 5 years, it keeps reducing. It's 7%, and over 10 years is 5%. So, what are the characteristics? I mean, is it just the fund stock picking ability of a fund manager? How does a retail investor have access to that kind of knowledge? I mean, it's only based on past returns, right? That a retail investor can judge, okay, this guy went right with his calls. How can one assess the future potential of a mid-cap fund? I mean, what are the key characteristics?
So obviously, the past performance is not indicator of future. But if someone is using, one should use it for longer term, because 1 year, all these deviations, what you are talking about, always happen. The primary reason, especially that happen in the mid-cap category, is if you notice top 10 stock of various funds. The names would be different, while in the large cap category, the names would be same and just weightages would be different. So in mid-cap category, it's peculiar in that sense. You have wider canvas to play, 150 stocks from mid-cap, then someone can add large as well as small in various proportions. So because of this wider canvas, fund performance of individual fund can be different in a year. And this deviation you will always observe in this category on a year basis. And always, if you then take a longer term view, then that deviation comes down in the best and the other funds.
Okay, so let's speak about this stock picking ability a little bit. Because like you mentioned that, top 10 stocks in a mid-cap fund would all be different, right? for an investor, right? If as an investor, I'm looking at, say, your stock portfolio, I see some bets which are outsized, right? So what does that say to me as an investor, that are larger, more concentrated bets better, or is it better if my fund manager has smaller bets, which are spread out?
Right. So at least for me, the way it works is my fund, if you look at it year ago, it would have been lesser number of companies and more concentrated. Today, you would notice higher number of companies. This number and the concentration are outcome of how many companies in your universe are really growing fast. If those companies, the number of companies which are delivering, if they shrink, then obviously in fund also I tend to concentrate in fewer companies and more concentrated and the fewer number of names in the portfolio. While if more number of companies start delivering, then you normally tend to widen. Now, in last 1 year, if you notice, various categories, which included especially in the Midcap pharma space and domestic pharma, started delivering on a relative basis. They have done better. So these are the choices which when you make when you see. We go through the entire universe and then see which are the companies that are relatively growing. If you find more, you can add more. If you don't find more, you can add less. So that has been at least the case in exercise.
Shreyash, do you normally tend to, use that entire 35% leeway that you have? So actually, before I ask that question, just a quick note to our viewers. So, when the recategorization of the mutual funds was done, there were certain criteria laid out by SEBI. Over the weekend, of course, you would have heard a lot more about it regarding multi-cap funds, but it's there for pretty much every category, right? So for mid-cap funds, 65%, minimum of 65% must be in mid-cap stocks, and the rest of it, 35%, could be either in large or small cap stocks. So, Shreyash, do you tend to use up that entire leeway of 35% to go outside the mid-cap end?
So 65 is for mid-cap, and yes, so 65, obviously we have to use entire 65, and based on the conditions, we increase it towards higher number as well.
Could be an average for your fund.
So it could be 65 to 70.
Okay, now my next question is a little bit tricky, and even I've been trying to ask several people about what is an optimum portfolio, right? Surely there must be one way in which a certain category of funds would fit, which would make it work best. So if somebody was to have a mid-cap fund, which other fund category do you think works best in combination with a mid-cap fund? Does it work best when it has the support of a large cap fund in the portfolio, or does it probably get that alpha from, like, say, a thematic fund? I mean, I'm not asking for asset allocation principles, just want to understand what you think is the most natural fit.
Obviously, the fit has to be with large as well as small, and that's where the multi-cap category comes into picture, or some focus category also comes into picture, wherein one can buy best companies, best 25 companies across the board. Today, I think one observation I mentioned earlier also, that our market is matured and our market is discovered. In this market, in a year, you may notice that mid-cap stocks are performing, but when you take a 2-year, 3-year, 5-year view, and even past performances of 2-year, 3-year, 5-year, 10-year performances, at that time you will notice that the performances are not too different. And why that happens again is because we are a matured market and the stocks are not undiscovered. So the quality mid-cap and quality small cap may not be cheap. There can be some smaller companies because of illiquidity, etc., that may remain cheap for some time, but then it catches up in 2-3 years. But point is, broadly, you will not see a quality mid-cap and small-cap company really cheap versus a large cap. And this is outcome of a discovered market. And in this market, diversification just by large, mid, small may help in 2 year or 1 year. But if you take a 3 to 5 year view, it is a widespread multi-cap or focus. The categories wherever there is one can have best stock across fund across market cap that yields better results.
Okay. Um, we've often heard of people talking about their turnover ratios, and as I understand it, it's different for every category, right? The indication. So, for a mid-cap fund, what does it indicate? Because given that it's mid-caps, right? I mean, this is the section of the market which tends to get outsized attention for that alpha creation. So, how should an investor look at the turnover ratio?
Actually, big cap funds turnover ratios, in my opinion, that is, I not check, but broadly it should be in line, if not slightly lesser than large cap. And I don't think it's category wise, frankly, which category should have higher or lower. Mid cap category. So when I manage a fund or anyone handles a fund, then probably while buying or selling, the actions are more driven by what are the change in the external environment. And so this churn ratio, so you take when the change in external environment are too fast and suddenly the pecking order of growth are changing, then you may notice higher churn. While if in a steady environment, when there is not much change, a particular sector is growing for years, during such times you will not notice much change in the turnover. So it is driven by underlying factors. What are the fundamentals of that? Whether the sector is or that particular company is in the growth phase or not. Whether it is peaking out in growth, and then the outcome is your churn. So churn along with returns, along with everything, all the parameters when a risk taken and a risk adjusted return. So everything one should look at. Only churn as a singling out a parameter, it may not help.
Shreyash, thanks very much for your time, and we will touch base with you another time for more on the mid-cap end of things. Thanks very much. With that, a quick break. On the other side, FISDM's Anand Dalmia joins in to answer the queries that have been sent in by our viewers. Do stay tuned in. Good afternoon. Joining in now is Anand Dalmia, co-founder and chief business officer at FISDM, who will be answering some mutual fund queries. Anand, good afternoon. The first query comes in from Jay Shan. He's a frequent person who writes to us, and he wants to know about two options. And this is very interesting because I haven't heard this comparison before. He wants to know, is investing in mutual funds or mutual fund based equity stocks like HDFC or Nippon, which is better? Well, Jayshan, I don't think they are comparable, but Anand, what would you say?
So I think, while, it's a very interesting question. The logic looks like why not an AMC rather than a scheme or a fund? I would say the first reason why we suggest mutual fund to customers is, for diversification, for, making sure there is a personal risk analysis, and accordingly a fund is suggested, asset allocation, you can start with 100 rupees. All these reasons, don't exist if you were to just invest in one particular stock. Secondly, while again, it looks like, okay, performance of a fund is the only parameter why an AMC should do well, there are a lot of other reasons like size of the AMC, distribution efficiency, the brand of the AMC. So it's not as simple as, the performance of the scheme translating into the performance of the AMC or the mutual fund house. And I would say, one should just think of a mutual fund or an AMC stock as any other financial services stock. So, mutual fund has its own virtues, or the scheme has its own virtues, and investing directly in an AMC stock has its own virtues. But they're not an option, you can't interchange them.
Okay. It looks like it's a day for very, very interesting questions. Gautam C wants to know what protects investors from poor decisions taken by the AMCs. And he actually cites the example of Franklin winding down its debt schemes and asks if there are any loopholes similar to that in equity mutual funds. He also wants to know why AMCs are allowed to charge expense for the same fund manager in different funds. Well, very, very interesting, Gautam. And over to Anand.
See, firstly, in terms of how do we make the right decision on a scheme, I would say informed decision making and professional help or guidance is what helps you. Today, there are 40 plus AMCs with 5,000 different schemes, and it's important to get some professional advice. However, I would tend to differ with this statement of loopholes because this entire industry is extremely well regulated by SEBI. And this entire Franklin episode, which may seem like someone losing a loophole, it is actually a risk that actually culminated and the fund house doing the best to protect the interest of the unit holders. So I think kudos to Franklin to actually have taken that step because they lose their entire AUM, and they've taken the flag to make sure that the customers don't have to take a big hit on the units. Some of the AMCs actually went ahead and just took the losses for the debt holders. So I don't think it's a loophole, and I think SEBI has done everything possible to make sure that there is no loophole. I think look, we can be rest assured that SEBI will keep on taking more and more steps to even make it better. But there's no loophole in the mutual fund industry. Sorry, Sumera,
yeah.
The third point of the question was, sorry, I missed that question.
The third thing he asked was that why shouldn't why should a fund be allowed to, AMC be allowed to charge expense for the same fund manager in different funds?
So I know all of us get fixated on, what is the expense that the AMC is charging. The AMCs are also, because end of the day, the performance that they deliver is what basically gets them more customers. But at the same time, let's understand that the fund manager's cost is a very minuscule portion of the entire cost of an AMC. The bigger costs are branding, distribution, RTA cost, exchange cost. And I would say the reason why they use the same fund manager in different schemes is because of the expertise of the fund manager and making sure that, the cost can be apportioned over various funds if the fund manager has the bandwidth. So it's not like, they're trying to make more returns by using the same fund manager in multiple schemes. It is, just that's a very, very small part of the cost. So I think we should not worry so much about it.
King Shuk has written to us as well. He wants to know the parameters used and the basis for increasing the total expense ratio once again multiple times a year. In fact, a lot of people have been writing in about why expenses are going up. Wants to know what's the rationale for AMCs to have more than 100 schemes. Okay, basically a lot of schemes and several NFOs every year.
The first part around so probably I'll answer the NFO part first. It's easier. So many NFOs. Again, the reason is there are 40 plus AMCs. Every AMC is a different point of evolution. So SEBI has come out with recategorization of funds. So an AMC can only have a particular fund in a particular category. Earlier, that never used to be the case. So in ELSS fund, there can be multiple schemes by one AMC. So SEBI has removed that to ensure that there is only one scheme in a particular fund. The reason why we see so many NFOs is the evolution of different AMCs. So there can be an AMC with just two funds, and as it grows, it's offering more products for its customer. The other is, AMCs are constantly trying to understand customer requirements and trying to create alpha for them, or trying to create products which meets their end requirements. So for example, in the last few months, we would have seen various multi-asset, NFOs coming up, international fund NFOs coming up, again, to make sure that, it gives access to a certain asset class that our customers want. So NFO per se does not, is only in the interest of the customers. It's not trying to increase the profitability of the AMCs, but I think, we can choose the NFOs that we want. Just because there's an NFO, we should not subscribe to it. And then, I would say, look, the industry as it grows, today we are 28 lakhs crores as AUM. So more NFOs are required and more assets or types of funds are required for us to really expand the size of the industry.
That's true, actually. And, like Anand said, that you don't have to subscribe to every NFO, but a full service AMC has to have every category in its portfolio. All right, final query. Sidhu Shah writes to us. He wants to know a couple of things. One is, okay, the first one is actually on SEBI. So I don't, want Anand to have to answer that because it is SEBI's prerogative as the market regulator. But basically, he wants to know about portfolio churn ratio and also, how do fund managers cope with index volatility?
Okay. I would say, the churn ratios, I think a lot of people talk about it. Frankly, I would say as a customer or as an investor, the fund manager's responsibility is to create alpha for us. Okay. And that's what should matter to us. However, churn is an important parameter for us to look at. At Fisdom, what we look at is just not the churn. We look at what is the strike rate of wins on those churns and the history of that. So, every AMC, firstly, we want to understand whether they are following a certain process, for them to do a churn. And again, it's a bit complex because there are different types of schemes and one generic answer is difficult. But again, at the core of it, I would say, it's not the churn, it is the strike rate or the win rate on those churns. That is something that we track to make sure that we can, pick the best funds for our customers. And that's what an investor should look at in terms of, not the churn ratios, but the win on this churn that the AMC is doing.
All right, Anand, we've run out of time for the last query on index volatility, but another time. Thanks very much, Sidhu. We'll take up your query again on Tuesday. Anand, thanks a lot. With that, we'll wind down on MF Corner. Do keep sending us your queries by mail and on Twitter, and do stay tuned in. The team of Closing Bell joins you next.